Do you want to know how the pros trade and consistently rake in high profits?
Then stay tuned.
In this video, we're breaking down 5 powerful trading setups, step by step, to help you catch the perfect entry and get the most out of every trade. Setup 1. Bearish order block and sell-side liquidity. We begin by noticing that price has tapped into a bearish order block, also known as a supply zone. This zone previously caused an impulsive down move, and we expect a similar reaction here. Buy-side liquidity has already been swept by the recent upward move, but significant sell-side liquidity remains, creating a target for banks. Additionally, there's a fair value gap in this zone, attracting price further downward. We place our stop loss at the top of the supply zone and set our take profit below the liquidity level, achieving a solid 5-to-1 reward to risk ratio. Setup 2. Key supply zone and fair value gaps. In the second setup, we observe that price has entered a key supply zone. This area previously caused an impulsive down move, so we anticipate a similar move again. Multiple fair value gaps here draw price downward, while liquidity rests below the recent highs of the uptrend, which banks may target. We place our stop loss at the top of the supply zone and set our take profit below the liquidity level, achieving a strong 8-to-1 reward to risk ratio. Setup 3. Bearish order block within a range. For the third setup, we see that price has tapped into a bearish order block that previously led to an impulsive down move. Price was within a range formed by equal highs and lows, creating liquidity both above and below the range. The buy-side liquidity has been swept, but sell-side liquidity remains intact. Below this area, we see equal lows, providing even more liquidity that banks may target. A fair value gap here also attracts price downward. We place our stop loss at the recent high and set our take profit beyond the liquidity, achieving a solid 6-to-1 reward to risk ratio. Setup 4. Market structure shift and bearish breaker block. In our fourth setup, we initially observe an uptrend, followed by a change of character due to an impulsive down move. This indicates a shift into a downtrend. We wait for a pullback into an area of confluence before taking our sell. Price has entered a bearish breaker block, a zone that previously served as support but now acts as resistance. This zone overlaps with the golden Fibonacci retracement zone. Most traders place their stop losses below the recent uptrend lows, creating sell-side liquidity that banks may target. We place our stop loss just above the breaker block and set our take profit beyond the liquidity, achieving a strong 8-to-1 reward to risk ratio. Setup 5. Bearish order block and sell-side liquidity in a range. In our final setup, we observe that price has been moving within a range, formed by equal highs and lows, creating liquidity both above and below the range, which banks aim to sweep. While buy-side liquidity has already been taken, sell-side liquidity remains. Price has tapped into a bearish order block, or supply zone, which previously caused an impulsive down move. We expect a similar reaction here. A fair value gap in this area draws price further downward. We place our stop loss at the top of the supply zone and set our take profit at the recent low, a key liquidity level banks are likely to target. This setup achieves an impressive 9-to-1 reward to risk ratio. These were 5 powerful trading setups that can help take your trading strategy to the next level. Have you traded any setups like these before? Let us know in the comments, and don't forget to follow for daily trading tips and strategies.